Hello and welcome to the IMG Investor Webcast for Q4 2021 for Caldera. Thank you for joining. We appreciate the chance to present a recap of performance and to highlight market conditions impacting your investment with us in Caldera. The hosts of today's webcast are Michelle Rivnak, Managing Director of Asset Management, and myself, Dave Mickelson, Director of Investor Relations. In today's webcast, we will cover year-end operations for Caldera with a look forward to the 2022 budget. As Michelle talks about operations, she'll provide some color into notable drivers unique to the property and its income and expenses, and how we plan to navigate those to maximize yield in the coming year. In the second half of the webcast, I'll talk about the property valuation, how it has changed since acquisition, and especially how it's changed over the past year. These investor webcasts are designed to offer a high-level understanding of your investment with IMG. If you have any questions from the webcast material or you want to discuss something outside of what we talk about today, feel free to call or email me. With that introduction, I'll pass the presentation to Michelle to discuss operations.
Thank you, Dave, and thank you all for joining us today. I will start our review with our property reserves, and we have this broken out into two separate categories. We have owner-controlled funds and lender-held. Starting at the top, we have an operating account, and the balance there is $742,473. We also have a capital reserve account, and that balance is $557,806. That has a total owner-held reserve balance of $1,300,000. Looking at our lender-controlled funds, we do have a replacement reserve. That's where we impound into that monthly, and we're able to draw from it on a quarterly basis. And that balance is $30,192. And then the combined real estate tax, insurance, and rate cap escrow account has a balance of $59,498. That combines for a total lender-held balance of $89,690. And if you combine owner-held with lender-held, we have a total all-in reserve amount of $1,389,969. That's a snapshot of time as the end of December for the reserves. And from there, we can go into our 2021 operations. We'll look at our actual numbers versus our 2021 budget numbers and talk about variances and main drivers. So going from the top, you can see that we actually beat our expectations. So despite the ongoing legislation that we're seeing in our operations, we were able to grow rents by about $20,000, which is 1%. Looking at vacancy, we did have savings there of $25,235. Vacancy was lower mainly due to the continued, not necessarily federal eviction moratoriums, but the statewide legislative restrictions that we have in place, where it does allow for residents that are not paying rent to stay within their homes. We're not able to do evictions while they're going through the process to gather emergency rental assistance funds. So looking at bad debt, we wrote off $21,112 as opposed to $142,000. So that's a huge saving of $120,888, 85%. Now, I guess a few things had happened here. The emergency rental assistance program had a certain set of rules when it started, and those rules evolved and then changed completely. So at one point, we thought we were going to have to write off 20% of all of the past or accounts receivable in order to qualify for residents to get emergency rental assistance. So that's what we budgeted in. The rules changed, and we were able actually to collect that 20%. So a double swing there. We didn't have to write it off, and we were able to collect it. So that was a nice change in the rules. So I guess all in all, we've had a lot of legislative restrictions, and it's interrupted our operations, but it seems that it's going to be a good thing in the long run, as it is taking a lot more time, but these federal funds are coming in, and we're able to collect that to offset accounts receivable that we thought we were going to write off. So I expect this to go into 2022. It's not over yet, but there is a light at the end of that tunnel. And more on that when we talk about our budget, but for the upcoming year. But total income variance is positive by 169,441, or 8%. So puts us in a really good situation at the end of 2021 when we're looking at income. Going into expenses, 2021 budget to actual, we did have higher expenses than we expected. It was kind of your minor increases in several categories. So there wasn't just one main driver, and it's a 2% difference. A lot of it is increases in supplies, labor shortages, and things like that. So $18,000 difference. However, we had that surplus in income of $169,000, which is offset by the 18. So we have a positive variance in net operating income by $151,000, or 12%. Looking at our debt service, our interest rates did go up higher than we anticipated when the budget was written, by $38,740. They were extremely low, so we're seeing the economy normalizes that is increasing. So you have your net number, $793,745, as opposed to your budget number of $603,634. So a positive variance there to end the year at $190,000, or 31%. We'll take that and look at our 2022 budget. And from there, we're going to look at our variances as well. So we're comparing 2022 budget to 2021 actuals. Now, a lot of moving pieces that we're going to see coming up this year, so bear with me as I kind of go through and discuss all the different topics. We've got our gross potential rent. We are expecting a 7% increase in total rents. That's $152,163. Now, we're expecting some of these laws to expire, some of the restrictions to give out, where we're able to have normal churn of residents moving in and moving out. And as we do that, we'll be increasing residents from their under market rents right now, and then to market rents as they move in. So $152,000 across the board. But with that, we expect our vacancy to increase as well. Averages are 95% occupancy, which we're looking towards for 2022, again, as operations normalize. Our bad debt, we do anticipate still writing off about $33,600. However, but we did close 2021 with $183,000. Now, the emergency rental program, it's been funded, it's been very efficient, and we've collected $247,000 in 2021. We expect out of this 183 that we see sitting in AR, we expect to collect the majority of it. But this 33,600, we are still expecting a few things to happen. Is some people just won't qualify for rental assistance. Some people have exhausted what they do qualify for. So as we see some evictions go through, we're expecting about $33,000 in bad debt there. That puts our total income 2022 budget at $2,376,000, opposed to our actual of $2,265,000 from last year. Gives us a positive $111,000 total income year over year, or 5%, looking from the year ahead. Now, we do have to consider our expenses. And there's a couple of things going on here in our expenses where you're seeing an increase of $160,000, or 19%. And they're big chunks, and I want to kind of talk through them. The biggest item is insurance. It's a $127,000 increase from the insurance policy we had last year. That's due to the open claim that we have. I'll talk a little bit more about that. There is a potential is if and when we finish this building, which would be in summer, that we can go back to the insurance company and attempt to renegotiate the premium We'll have to see how that plays out. This budget does not anticipate that, but it is definitely something we're going to go for and do. I'm not sure how much we can get it reduced, or if we'll be able to. Maybe also they need to change carriers. So there will be a lot of insurance information happening in 2022. We'll keep you posted on that. The other item is $60,000 in payroll. Now, in 2021, we received payroll forgiveness from the Payroll Protection Act that just deleted $60,000 worth of payroll off of the books. So it's not that we have this huge increase in 2021 or in 2022 budget. It's just that we had such lower actual costs in 2021. So the 2022 budget is more in line with the 2021 budget, but just not the 2021 actual because of that $60,000 in forgiveness. So I just wanted to keep that in there. That takes our net operating income to a negative variance over last year by $48,615. Our debt-related, or 2021 actual, was $539,000. We're expecting that to increase by $42,000 to $581,000 over 2022, which takes our net number down year over year by $97,293. Keeping in mind $127,000 is insurance and $60,000 from payroll. So there's a lot of levers here for us to pull and a lot of variables in place. So we'll see, can we move rents higher? Can we increase renewals more than we anticipated? Depending on how much we can collect from our rental assistance programs, really focused on that. And then trying to get this insurance policy negotiated mid-year after the rebuild is complete. So those are some variables that we're seeing, but I think this is a realistic and conservative budget for our expectations going into 2022. And one last comment is that net number you're seeing, $696,453, that is used to supplement reserves. That's used for monthly distributions and any capitalized expenses that we're going to have. So one last topic I'd like to talk about is insurance, specifically the insurance claim that we have here at Caldera. Just want to give you a recap, kind of top to bottom. It's been going on for a while. These insurance claims take far longer than anyone cares for. But we did have a fire the end of June 2021, impacted 4 units and 2 garages. The demolition and mitigation are both complete. The insurance provider is using creative contracting. They've put a bid together for the rebuild of $340,000. However, to ensure the costs are reasonable and that we're getting the most expanded scope possible that the insurance company will pay for, we're also getting an additional bid so we can apples to apples comparison the scope and then have another expert look at it to make sure nothing's getting left out. And that's with J.R. Johnson. So J.R. Johnson is drafting a structural engineering drawing, and that's going to be submitted to the city, near complete on that, making sure all the code upgrades and everything is included. Talking about the fire report from Clackamas Fire Department and the fire origination report from a separate entity, both confirm that the fire was a result of the tenant's actions. So we're pursuing the tenant's renter's insurance policy for that. To date, we've recovered $306,000 from insurance for repairs, anything that we've had to pay so far, an additional $45,000 to be received when repairs are done. So we're expecting the entire amount to be about $351,142. We've also received rent loss of $27,519 through December, and we're expecting additional rent loss as this goes through 2022 to get that reimbursed as well. So we'll see that probably mid-year again as the rebuild is complete. So that gives you an update on our specific claims, but I'd like to expand on insurance just a little bit more because it's such an increase impacting Caldera. But we're actually seeing this be the fastest growing expense across the IMG portfolio as a whole. we're looking at a 40% year-over-year increase on average. Some properties not hit too hard, some with a claim obviously getting hit harder, Caldera being one of them. We're seeing four main drivers push insurance rates. One is, in general, insurance companies have had higher losses due to extreme weather patterns, and they're increasing their premiums to match that, as well as higher costs for construction, supplies, labor. That's going up. So premiums, again, increasing to match that. Now, the two property-specific items that are driving insurance costs is building value. So as we do upgrades, interior unit upgrades, exterior items, the property becomes more valuable, and then therefore it costs more to increase that coverage for the new building value. So it just becomes more expensive to cover the building. And then claims history, as we're seeing here. If we have a claim, the renewal rates are mind-boggling at some points on how this is being increased. And again, we're going back to talk to this insurance company and see if we can get that reduced when the build is done. One other item on the insurance side is renter's insurance. Now, we have been, in some cases, and we're pushing this across the portfolio, of pushing the residents' $100,000 insurance liability to $300,000. And it just so happens that here at Caldera, this resident was responsible for this damage, and they have a $300,000 policy. So we're ensuring, not at Caldera, but just not only at Caldera, but across the portfolio, that all of these policies are going from this national standard that's been in place for I don't know how long at 100,000 to push it to 300,000. Just the same way insurance carriers are increasing their rates to, with normal inflation, $100,000 just doesn't go as far as it used to when it comes to repairs. If the residents are not able to pay it, those high dollar damages, they do eventually come out of ownership pockets. So we're having that in place. We did have it in place here for this event, and the insurance is going to the renter's insurance policy. Once that finalizes, and if we're able to truly push all of the liability on that of this claim to the resident, that would also help in the negotiation of reducing our insurance policy premium. So all of those things are in play. There's a lot of insurance that we do. And to top off the topic, we've actually hired a new risk and compliance coordinator to work in our asset management department. I can tell you I'm extremely happy to have him on board. An extra set of eyes and hands to really follow along. This is such an important topic. It's such a large expense to make sure that we're doing everything we can to get the property the coverage that we need, the residents to be coverage that they need to have, but also do it in the most economic way possible. So happy to have another person on board to help with this administrative task. And with that, I will hand it back over to Dave, and he's going to talk about our broker opinion of value.
Thank you, Michelle. Great discussion on the performance at Caldera. Nice work working through the burn unit and the insurance issues, and great update there. Big year, and hopefully we come out on top and able to reduce that insurance expense and do some of the things that you're talking about in your presentation. We'll all talk about the broker opinion of value here, and this goes hand in hand with the other half of our investment performance, right? Part of the yield on the investment is driven by our operations and what kind of current cash flow we're able to produce from the operations of the property. The other, usually bigger part of the investment return comes through the sale proceeds. And so the opinion of value conversation is always important there because we can track over time how our equity has grown and how the building is appreciated through time. You get kind of a feel for how we're doing in terms of total health and total return on the investment. On this slide here at the top are details summarizing what we bought the property for, the purchase price, and the basis that we had starting in November 2017. So as a recap, the purchase price was just over $19 million. We came in with CapEx and closing costs, and the all-in capitalization for the property was about $160,000 per unit. Now, an important number to keep track of here is the cap rate that we bought at in 2017. And the trailing true cap rate at that point in time was 4.7%. A couple of years later, or I guess 3 years later, and this is just last year, we refinanced the property. At the refinance, the appraised value came in at over $27 million. That's $200,000 per unit and a cap rate of 5.3%. Now, with the most recent opinion of value that we got from CB Richard Ellis as of last month, they have noted that cap rates have come down in the Portland market, and we've seen this across the nation, cap rates coming down. And with cap rates reducing, well below our acquisition cap, well below our refinance cap, to a range now of 3.4% or 3.7%, you can see that propels the value of the property up, and the most likely sale price, according to the broker, would be in the $35 to $37 million range, which is just about $260,000 per unit. So really a fantastic rate of return on the equity gain side and the equity multiple since we've owned the property since 2017. This sheet too is a helpful kind of tracker where we can gauge our performance by a couple different measures. First, like we did with Caldera and we do with all of our properties, when we put together the financial model at acquisition, we're making different assumptions about how the property will cash flow over time and how the property will appreciate over time. And so in 2017, when we published the financial model and raised the equity for this investment, our projection at that point was that by now, 4.3 years into the hold period, the value of Caldera would be about $26 million. If we compare that to our opinion of value at 35.2, you can see we've exceeded that by about $9 million. So that's the first really positive indicator for our value growth. Also, a couple other comparisons here. One way to look at our value growth is our original equity, and our original owner equity in the deal was $8.3 million. After refinance, about half of our equity came back to owners, came in two tranches, one right at the refinance and one about a year later. And now with those capital proceeds returned, owner equity in the deal today is about $4.2 million. And so that's another metric that we can look at in terms of equity multiple. So finally, to kind of close that loop, with a value at $35.2 million today, if we subtract the debt of just under $19 million, that gives us current owner equity of over $16 million, or about a 4x multiple on our current post-refinance owner equity. That'll be a conversation I think that maybe picks up as early as next year, and the ownership group starts to talk about the next chapter for the property. When we refinanced, we'd assumed another 2 or 3 year hold period. So as we talk next year, we'll be into year 3 of that hold period, and I assume we'd make some decisions about a potential sale at that time. Here on this slide, I just wanted to touch on a few interesting points, some at IMG and some at the property level, that are affecting our performance going forward. The first is a theme that Michelle started when she talked about the addition of our risk and compliance coordinator. That's been a huge asset, as she mentioned, to track insurance, make sure that our tenants are compliant with the guidelines, make sure we've got sufficient coverage and that we can pursue claims as they occur. So that was a huge addition to the asset management team. Also, wanted to highlight last year we made 2 other significant additions to the team. One was an additional asset manager, and then another was a project accountant who's dedicated to the CapEx tracking and reimbursements from the replacement reserve from the lender, et cetera. And so with the addition of these 3 new pieces in place for our asset management team, just what underscores the importance that we place on asset management, the investment that we want to make sure that we've got good oversight, qualified and expert people watching the investments and kind of maximizing the performance over the hold period. In Portland, over the last year, the market recovered pretty well. You can see on average about a 9% rent growth gain on new leases. The reason I say pretty well is compared to other markets, that's probably on the low end. We've seen other markets as high as 15% or even above that. So I think Portland and Seattle are on the lower side of what the rent growth was. But in spite of that, really a positive kind of stretch in the right direction after a couple of years of kind of flat or stagnant rent growth through the pandemic. I think Michelle talked about how we're seeing income gains projected for this year. And I think it's also helpful to compare, where are we for 2022, also compared to where did we think we would be back when we put together the acquisition pro forma 4 years ago. So back then, we'd anticipated for 2022 an NOI of just under $2.3 million and a net income around $700,000 for the year. And really tracking right along with that, our 2022 budget also projects pro forma NOI right at about $2.4 million and a net at about $700,000 as well. So, sometimes we come close. Sometimes we've got a little bit of gap between pro forma and actual, but for Caldera, we're actually right in line in terms of performance and are way outperforming in terms of value. Last year, cash flows remained at a consistent 7.62% return. That return is based on the current owner equity of just over $4 million. Based on the reserves that we've got in place and how we see the property performing for the next year, we'd anticipate that cash flow rate to be stable. And then always, if we have surpluses and if we're able to accrue more in the operating reserve that doesn't go out in the monthly owner distributions, our goal would be to send out additional distributions during the course of the year or raising that rate, whichever one applies, but making sure that we're pushing out as much cash to the owners as we can. To close, I'll just mention kind of picking up 2022 here and what we accomplished in 2021. Last year was a huge year for us with our acquisition velocity and our dispositions. We bought 7 properties over the course of the year. We sold 4 properties. On those sales, we achieved average returns over 22%, which is about 50% above our projections. Also exciting last year, of the 7 properties we bought, one of those was in a new market for us, Greenville, South Carolina. And I think that's indicative of how we're going to approach the market as we keep our momentum in 2022. We talked about the cap rates, how they've come down. That makes it challenging for us as a buyer because as the cap rates come down and as the asset pricing goes up, your yields also usually get pinched. And so we've seen that with cap rates coming down, it's harder to, maintain the cash flows that we've been accustomed to in the last couple of years. And so for us, that just means being disciplined in how we underwrite, making sure that the properties we're acquiring are solid performers, that we can add real value in the CapEx and the management expertise that we're bringing during the hold period. And then also making sure that we're exploring new markets where we think maybe the potential is there, but they've been less discovered and the bidding activity is lower. And so that's worked well for us in the past. I know we were early into Raleigh, early into Charlotte. Going forward, and even in the last 3 months, we've looked at markets in Tennessee. We've looked at new metros in South Carolina and North Carolina. We've explored possible acquisitions in the Portland and Seattle markets. Also looked at Denver, and also would love to be in some additional metros in Florida. So for us, we're excited about the opportunities that the new year brings. It's an additional challenge based on the cap rates that we're seeing in the market in the 3.5% to 4% range, but completely are expecting success and believe that we'll find good assets that can outperform and get creative in the way that we pursue and secure these acquisitions. So we'll plan to send announcements as we have new deals come to market. Really, we should have a new deal come to market in February. And so really, I'm excited to send an announcement next month when we've got our next deal secured and we're open for additional investments. Well, that'll close our presentation for today, and we appreciate you staying with us. We appreciate the partnership we have with you in Caldera, and we look forward to a very positive year ahead for the property. Our next webcast for Q1 2022 will be presented at the end of April. This will conclude our presentation for Caldera today. Thanks again for joining. Have a great day.